Hi there, I'm Max Keiser. This is the Keiser Report. The world's economy is rolling toward bifurcation. There's a word to look up in your Funk and Wagnall. Stacy.
Yes, of course. We've been talking about that for quite a few years, that Cantillon effect at the top. The 1% get to benefit from all the money printing. Their asset prices go up, whether property or their stock portfolio. Austerity for the bottom 99%. And we've really seen that in the global insurrection against banker occupation starting to rise up again. We reported that you coined that phrase, Giabo, back in 2009 and 2010 during the many uprisings and protests around the world we started to see. So I just wanted to follow up on our interview with Dmitry Orlov, because I think that, in fact, a lot of these protests are indeed genuine. Of course, other nations and sort of players and geopolitical players and great powers and stuff tried to intervene. But in fact, if you saw like over 1 million protesters demand Chile president's resignation. He's a billionaire, he's imposed austerity, and people have had enough.
In Chile.
In Chile, we've had protests in Lebanon, we've had protests in Haiti, we've had protests in Egypt and Spain. So a lot of them are about this global insurrection against
global
banker
insurrection against banker occupation. That's what we call it. That's what we said. And you know what they got over there? It's what I came up with a new metaphor. It's the snowblower. You know that with the snowblower, you know, you push it down the sidewalk or the road there, and it blows all the snow off to the side. So basically, and it leaves a flat, non-snowed surface. So these central bank policies, they blow all the money into the pockets of the top 1/10 of 1%, and they leave everybody else without anything, right? And they do this with financial engineering and via policy initiatives. It's not an accident. It's not, these huge wealth and income gaps don't happen because of some odd accident, by design. And you know, we've shown on this show for 10 years, like, okay, we said Jamie Dimon was engaged in racketeering to fix prices in the gold market, to manipulate prices, and to ingratiate and to, you know, impoverish a lot of people. And then it took, finally, he's now being investigated and prosecuted under racketeering, right?
Those are individual crimes, and those are with bad intent. The central banks and the treasuries and the fact that the treasuries and the governments have abdicated their role in the economy to the central banks, who they believe are experts living in ivory towers. Those people might think they're well-intentioned, but what they have created is a globally precarious situation. The vast majority of people are precarious, and they actually have to work for a living.
Right. But okay, so over there at the Bank of England under Mark Carney, it was shown that he, as an individual, was engaged in LIBOR rigging.
Yes.
Okay, as an individual. He runs the central bank. So there's a few main central banks run by individuals, and they're committing fraud.
Crime starts at the top, as Bastiat would say, and trickles down. That's the trickle down. The system itself is rigged, and therefore anybody who has a job within that system or functions in that system will become corrupted by that fundamental layer that is the corrupt monetary system. And here, for example, in Chile, and why people are protesting here, and why I believe they are genuine protests, and sure, outside actors may intervene at some point, or perhaps they are, and whatever. But 1.5 million people showed up in the streets. Branko Milanovic, who is one of the experts, if not the foremost expert in the world on inequality, and he has studied this for the past few decades, he tweeted, in the new 2013-2014 global income distribution data just completed, the bottom 5% in Chile are at the same income level as the bottom 5% in Mongolia and Moldova. So we all recognize that Moldova and Mongolia are developing nations, they're poor nations, and the bottom 5% in Chile are equal to those. Meanwhile, the top 2% in Chile, and this is probably underestimated, he says, have the same income as the top 2% in Germany. Germany is an industrial powerhouse with a massive export market, huge wealth creation, and the top 2% in Chile are equal to the top 2% in Germany.
Right. Well, you've seen those T-shirts or bumper stickers or whatever that say the beatings will continue until morale improves. Right? It's ironic, right? Because morale's not going to improve if you keep beating on people.
Yeah.
Now, here in Chile, the policy is to bankrupt the country, to eviscerate the middle class, and to reward the kleptocracy. That's the policy. And those are the when this kleptocracy notices that there's 1 million people on the street that have been impoverished due to their policies, their response is to double down, right? It's like that in one country, they use this phrase price tagging. If you point out how they are engaged in massive corruption, they double down. So here in Chile and in other countries, if you point out to them, hey, you're engaged in massive corruption, they double down and they just make you even more impoverished. And there's no pushback. There's no law against it. And in the United States, they've gotten rid of all the regulations, right? So there's no way to stop it. In the Bank of England and in England, of course, it's the purest case of a kleptocracy. And so now that's been spread to the core business model of all central banks.
There are conspiracies going on all over the place. And as we pointed out, the conspiracies to rig precious metals markets, we presented it here on Keiser Report back in 2011. People said it was a conspiracy theory. And indeed, it was a theory of ours that it was being rigged and there was racketeering going on. It is now a conspiracy, indeed, in fact, as the Department of Justice is charging them. There is a conspiracy going on in the repo markets. We know for a fact that central banks, well, the New York Fed in particular, is conspiring to rig something. We don't know what is going on because it is a black hole. And a black box. We don't know which bank or which shadow banking member, like who is in trouble. And we have this headline tweet here, in fact, from Fred Hickey, and he says, this massive daily Fed intervention business appears to be getting worse and worse. What is the Fed hiding? The longer this goes on and the bigger the interventions get, the more my confidence is shaken. I expect that's true for other investors too. And he was responding to a tweet from Brad Houston about the Fed temporary repos. On September 17th, they said, we're doing repos today and tomorrow. On September 19th, they said, we're extending repos until October 10th. 75 billion overnight, 30 billion term. And then on October 4th, we're extending repos until 11/14, 10/11. We're extending repos until January 2020, 10/23. We're expanding overnight repo offering to 120 billion and 45 billion term.
There's a run on the bank for the highest liquid, shortest term base money paper. And there is not sufficient quantities to keep the system afloat. And some major bank, could be JP Morgan, that's my guess, is soon to announce bankruptcy or insolvency, or Deutsche Bank. And this is, of course, I've looked at the numbers. Not since 2021 have we seen such a collapse in base money.
In fact, we're going to go to a headline here, and it talks exactly about that. And that shows the data that the base money supply is declining at the same rate of 1920-21. Gold, credit, and the coming financial collapse. Since 2016, the U.S. monetary base has declined by about 23.68%. This is the deepest and longest decline since the Federal Reserve was formed. On December 23rd, 1913, this should not be ignored. The last time there was a decline close to this magnitude, there was a sharp deflationary recession. That was the one that occurred from 1920 to 21. Here's today. You can see the decline in the monetary base, and back there in 1920-21. And just for the, definition purposes, that we're all on the same page, he defines the monetary base as the foundation part of the money supply and represents the most liquid part of it. It basically acts like gold in a 100% funded gold standard. It represents the final settlement of a transaction.
Right, that's the key, the settlement layer, as it's called, with the most liquid, highest grade paper, government paper. If these banks, like a JP Morgan or a Deutsche Bank, are unable to settle trades because they don't have the cash to settle the trade, then when the end of the quarter comes, they're going to have to, by law, if there is the rule of law anymore, and that's an open question, announce that they are insolvent. And therefore, they're going to set off a cascade and a contagion that will be a continuation of the 2008 crisis, but much, much worse, because in the 2008 crisis, the response by central banks was to inject 16 or 17 trillion of money into the system. And the hope was that this would create growth, GDP growth, and taxable revenue to pay down some debt. But instead, the banks simply took that money and hoarded it on their own balance sheets. And they, in turn, did not lend it out into the economy. They did not create any meaningful GDP growth. And in fact, over-leveraged the economy 10 times greater than it had been in 2008. So now this debt bomb is exploding. And the Fed is desperately trying to cover it in the repo market, which is like trying to put out that fire in California with a squirt gun.
So the final settlement of a transaction, that's cash, that's gold, that's Bitcoin. There's no counterparty risk. These people in the financial markets do not want to swap that for any instrument with a counterparty. We're seeing a huge run on the counterparty market. Nobody wants any sort of instrument with a counterparty, it would seem. During the 1920 to 21 recession, the decline in the monetary base eventually made it into the broader money supply, and this caused a significant drop in price levels between 13 and 18% during the recession, with wholesale prices dropping as much as 36%. This is not yet filtered into the market. Perhaps it might not, but at the moment, even though it's down more than it was in 19, 20, 21, if the monetary base is declining, then less means to service debt is available and could trigger mass defaults. Cash becomes scarce, and suddenly you have a situation where the Fed has to intervene in the repo market like it has been over the last couple of weeks just to keep the system going.
Right, so going back to 2008 when this all started, this is why pundits like Peter Schiff got it wrong, because he was calling for inflation.
Yes.
And people like Rick Ackerman, who are on our show, were saying, no, this is deflation. And now we see that it is a massive deflation, a deflationary depression where prices collapse. And this is what we're facing now.
That's what they're suggesting. Of course, this is the jump up. You see a massive, probably the highest percentage increase in monetary base in the entire chart since the beginning of the Fed. That did happen in 2008 and 2009. Perhaps they saw a different outcome that didn't.
Well, that was a bailout, and it wasn't put into the economy. They bailed out the creditors, thanks to Barack Obama, who made the 180-degree wrong strategic choice and set the country in a course of epic failure. Thanks, Obama.
Did you see, by the way, that I got rid of that spider that was climbing down here? I think it was left over from Halloween.
Oh, the itsy bitsy spider. Much more of that coming your way. Was this? Oh, after the break. Don't go away. Welcome back to the Keiser Report. I'm Max Keiser. Well, we are fortunate indeed to have in the studio with us, in person, David Morgan of the Morgan Report. David, welcome.
Max, thanks for having me, and so I am paying you off. We'll start the show off.
What do you got there?
That's $1, and most people don't even know $1 is a weight. It is a weight of silver. 371.25 grains of 9995 silver, which is about 3/4 of a troy ounce. So the Treasury can't even get it right. When they mint the new dollars, it says $1 on them, and it says $1. It's a full ounce, which is actually about a 25% gain in silver. So they don't even know it's a weight.
But let's get it. So thank you so much, and I'll cherish this. Now let us proceed as we are wont to do. I need to pick your brain. You know, you've been in this business a long time. We've been doing shows together for a long time. We're so old. Do we remember when gold was $2,000 an ounce?
Exactly.
The Fed's repo operations are rapidly increasing in size and scale. Should we be alarmed? What's going on?
We don't know exactly, or I should say I don't know exactly, but it's obvious there's some insolvency. There's banks that are illiquid, they need to borrow, and no one wants to go to the discount window of the Fed for the borrowing money of last resort. It means something is drastically wrong in the system.
All right, let's unpack that a little bit, because in other words, you're saying there's an insolvency somewhere in the system.
Right.
And so why would, and they don't want to go to the discount window, right? So explain more about what does this all mean?
Yeah, banks, so there's an overnight lending rate, and that's based on bank to bank. So every bank is required to have a certain reserve of cash on hand. If they don't meet that requirement, they have to borrow overnight to meet this the law.
That's a regulation.
That's
so
a
you're supposed to have
regulation.
certain reserves based on how much you've lent out. You need to have some certain bank on the reserves to maintain the ratio
Yep.
per law.
Correct.
Right? So
Exactly.
go ahead.
So to meet that requirement, if you're short, you go to another bank that might have an excess, and they can loan you that money overnight, and you pay a small interest for that loan. And then the next day, the books are square and life goes on. However, if you can't find a bank that will loan you the money, you can go to the Fed and say, at the bar of last resort, hey, I need to borrow to meet my reserve requirement, loan me the money overnight. Well, that's kind of telling the system, the banking system at large, that no bank will loan to me because I don't trust the bank that needs the money. I have to go to the Federal Reserve to borrow it. So it puts some caution in the system because people or the banking system wonders, why in the heck does this bank get rejected by every other bank to borrow? I have to go to the Fed. So it's sort of the walk of shame to go to ask the Fed to borrow money when another bank or other banks won't loan to you. Well, this is happening again and again and again, as you well have outlined. And
Every day we get the same message that, oh, we need a repo, we need to extend it. So now your feeling is that this pertains to one institution in particular that is not being named, that is having trouble staying out of insolvency?
Could be, but it's immaterial in a way because all these banks are inextricably interconnected, which means if it is just one and it falls, then it hits 2, that hit 4, that hit 8, that hit 16. They're all interconnected, so it could take a Deutsche Bank going down, or like Lehman, where you see this interconnectedness of these banking system at large start to fail. One goes down, a big enough one will probably take everything with it. I mean, if you go back to the 30s, the Credit Gestalt Bank wasn't a very big bank, and no one really thought much of it going down in Austria, but that was actually the first domino of the system.
Right, and then you had Lehman Brothers, of course, in 2008. It was kind of a domino.
Yeah.
In 1920-21, there was also a similar kind of collapse. And let's talk about base money for a second. The base money supply has declined by over 23% since 2016. This is by far the longest and deepest decline since the Fed was created in December of 1913. The inflation-deflation debate could be resolved soon, and the winner could be deflation. Okay, so the base money supply has declined 23% since 2016, and that's the biggest decline on record since the Fed was created. What does that mean? What does that tell us?
Well, it does indicate it could be deflation. I mean, when I started this career and started the public speaking circuit, I was more of a deflationist than an inflationist. I got turned around several years ago because Jim Poplava did a study of all non-backed currencies, and everyone ended in an inflation. But if you go back earlier, any gold-backed currency like we had in the 30s was a debt liquidating depression, which was a deflationary depression. I don't rule it out entirely, but I think it's unlikely the end game will go that direction.
Well, the point here is that the base money is the gold in the system today.
Right.
Right? And so using that analogy, if in fact the base money is declining rapidly and you have an institution that's in distress, or many institutions that are in distress, and they can't meet their requirements, then it's a setup for some defaults.
Yeah, there's built in the system, as you and Stacy well know, that if you can't pay a bond and you default on it, interest rates will start shooting up, which means the value of the bond comes down drastically, like what happened in 1980 when Volcker was in charge, which is hugely deflationary. I mean, think about interest rates going to 10%. No one could meet their debt obligations from the government side, and yet you would have a huge deflation in the value of those bonds. And so I don't rule it out. I think it's still a debate. I think it's still open. I think it's still.
Well, the other side of the inflation deflation coin is something called hyperinflation, right? So in other words, it's not bad for gold and silver investors to have deflation if it means you have a currency collapse.
Correct.
Right? And so we've seen currency collapsing all over the world. Gold's made new all-time highs against just about every currency in the world except the U.S. dollar.
Correct.
So we're already seeing currency collapse right now, and it is benefiting gold and silver.
Exactly. And to further your point, if you read The Golden Constant by Professor Jastrom, his whole point is that gold does best in a deflation. have to take into account that most of his study had to do with the gold-backed currency in most of the sectors that he studied, but nonetheless, it's a good point to keep in mind. An inflationary depression and a debt liquidating depression aren't that much different. In one, you lose faith in the currency altogether. You just absolutely don't trust it at all. And in a debt liquidating depression, currency becomes valuable again, and people, of course, trust it, so you can restart the system. Morally, in my belief, the debt liquidating depression is actually more moral than an inflationary depression.
Right, because the bad guys get spanked for having incurred such a horrible incursion into zombie companies, zombie banks, and they're just being kept alive through machinations of the Fed and this type of thing, and they need to be punished.
Exactly.
They need to be punished, David Morgan.
You know, for me, the idea has always been, and I'm an idealist, as you know, Max, but I mean, the right to succeed is also the right to fail. And if these guys make bad loans and do the wrong thing, they should be punished. I mean, the market should be able to work both ways.
That's why Obama should have bailed out the debtors, not the creditors. Yeah. Right? I mean, okay, so anyway, so Alasdair MacLeod of goldmoney.com recently suggested that China could soon announce it has 10,000, perhaps 20,000 tons of gold. Is this crazy? Is it possible? What are your thoughts?
Well, he and I are not super close, but you know, we have our private talks down and then. I don't think he's crazy. I wouldn't go with 20, but 10 I don't think is out of the question. But the answer is no one really knows.
Okay, but the premise here is that they've been secretly accumulating a huge stockpile of gold as kind of the nuclear option against the dollar in the U.S. If this trade talks with China go badly, China can whip out this nuclear option and say, you know what, we actually got 10, 15,000 tons of gold. And the dollar's now finished, and we're going, us, Russia, and somebody else maybe are going to go to a gold-backed currency. You know, forget it. You're toast.
Right. One fine point that very few people know about the amount of gold that China has is asking the wrong question. When they report the amount of gold, what has happened is it's asked specifically how much gold is held in that bank in China, and they give you the answer, instead of asking the correct question, which is how much gold everywhere in China is held under the national name. They don't ask that question. So the Chinese are actually answering a very explicit question in a very explicit way. So no one really knows the amount because they don't actually report everything. They're reporting what's asked for.
Who's the biggest gold miner in the world?
Probably the Chinese.
And do we ever see a gold ingot with a Chinese stamp on it?
Never. Well, I mean, you see them, but they stay in China. They're not allowed to export.
They don't leave.
Yeah, you see pictures of them.
Right.
Yeah.
Plus, they're buying everywhere.
Exactly.
And they by official reserve number, they're number 2 or 3, I think. Mm-hmm. And so they could easily be number 1 on a stealth.
Right.
The stealth basis.
Agreed.
So China has changed course from a more secretive to a now more public about the gold holdings. But even so, they seem to be opening their kimono to mix Asian countries a bit, to maybe telegraph that this is coming. If you continue to pressure us, you know, we're going to start to leak information into the marketplace that, you know, we actually have a little bit more than you thought. No, actually, it's quite a bit more. Like they're playing this cat and mouse game on trade. Does Trump, does he understand that? Like, does he have the intellectual chops to understand it? Like if somebody came to him and said, you know what, China could, you know, announce they've got 15, 20,000 tons of gold. Would he know what that means, or would he have to explain that to him?
I think he probably would know, at least intuitively he would know, in my view. But nonetheless, I think he would need the details to make a, you know, correction, decision.
So it could be the Pearl Harbor of 21st century.
It's possible.
That could be wild. All right. So last week, President Xi over there in China said that China should implement blockchain technology across the economy. Again, is this part of the disintegration of the U.S. dollar as a weaponized global financial grid? So President Xi of China, you know, they've been flip-flopping back and forth. They come out and say, you know, actually, we like blockchain. Blockchain is a threat, according to Brad Sherman in California. It's a threat to the dollar. Not China saying we like blockchain. Your thoughts?
I think part of the whole crypto thing, and Bitcoin is probably the prime example, has to do with the cashless society. I really think that's the big move for the bankers. I mean, a lot of people get really mixed up in politics, and that's okay with me. I let people be themselves. But I love to show the slide that I put in most of my talks these days, and that has to do with the movie Thrive. And in that movie, it shows your pyramid. And the bottom of the pyramid is the political class. And everyone thinks they're the big leaders. They see him on TV. He's got the biggest power and all that. But above that is your your huge conglomerates, your big corporations, and takes you back to the movie Network, where I forget the character's name, but he says there's no China, there's no U.S., there's no Mexico, there's only AT&T, 3M, and this is the truth. And then above that is your commercial banks, and above that's your investment banks.
You have meddled with the universe, Mr. Beale.
Yes,
Right?
Mr. B, that's right.
We're going to cut it off there, but we're going to pick it up in a second segment, if you can stay.
Oh yeah.
Don't go
I
away.
don't leave till 4.
Don't spin on your chair. We talked about that in the beginning, David.
I thought we were
No
done.
chair spinning. All right, that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank our guest, David Morgan of the Morgan Report. Catch us on Twitter at Keiser Report. Until next time, bye, y'all.